Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is actually Sunday, January 11th, but this video will cover the market ending the week of January 9th. And you're looking at a daily chart of the SPY. And if you recall, if you go back to the videos from earlier in the week, I said that Wednesday, plus or minus one day, would be a turn day in the market, and that proved correct. We turned up from here, and we only turned up for about 2 days. And then on Thursday, I said another cycle day was due on Friday, the 9th, and that proved to also be correct. And Friday was one of our rare down days in the market, but it was also a cycle turn day, and we did turn down. So cycle turn days aren't necessarily up or down. They just happen to go in the direction or in the opposite direction of which way the market has been going in the recent past. So if the market's been going up for 3 or 4 days in a row, a cycle turn day will turn down, and vice versa. So we had a down day on Friday, and here's what I really think is happening here. I think that the market in the month of January is going to make a more significant low than it did here or here. And it's kind of like we're more overdue for a let's scare everybody and make everybody think that the market's collapsing, and we really didn't get there yet. And that's what the market's designed to do. It's really designed to trick everybody, and it typically does the opposite of what people think. When the market's grinding higher, there's plenty of people that call for a crash, a collapse, the market's overvalued, all that stuff. And when it's going down, you have the buy the dip mentality, and people step in and tell you why the market's undervalued, and then it can continue to go down farther and trick those people. So what I think is going on, and it'll be a telltale sign if we can break this low here. So this low from the SPY at 198.85. We have to close below this low here in order for that kind of scenario to play out. And if we close below 198.85, I don't think that this 200-day will hold, because we kind of came down here close enough to where I'm not sure that this will provide the type of level of support it would have provided here. Okay, and if that's the case, remember my third target from a few days ago was this gap window here, which would be 191.48, and this gap fill, which would be 190.45. So let's just say in between this area would be a very, very good level of support if we broke this low here at 198.85. What happens Monday? I'm not sure. I have a funny feeling Monday's going to continue down, but I don't have anything definitive to tell us that. We just take it one day at a time, and being that we did turn on Friday and it was a cycle turn day, we certainly could see some more downside potential in the market. But until we break this low, the market would still be in a bullish uptrend, if you will, and we'll have to just take it one day at a time and see what happens from there. So, let's see, what else do I have? I'm looking at my notes here. I think I covered everything I wanted to. Oh, by the way, yeah, one other thing. This week is options expiration week. And what that means is each and every options expiration week, you have the institutions that can whip the market around. They have a lot more capital to play with than you and I do. And if the institutions decide to take certain stocks up or certain stocks down and take out the option players, those that bought calls or bought puts at a certain level, they'll move the market one way or the other. It's very easy for them to do, especially if there's light volume. So you have to be aware that during options expiration week, sometimes what you see is not all the time what you get. So you might see an up day on one day, and then the next day follows with a down day. Let's say we went down on Monday. You wouldn't be shocked to see an up day on Tuesday, and then both a whipsaw up and down on Wednesday. That happens a lot during options expiration week. So it's a very difficult week to trade during options expiration week. So you really have to have the premier setups in order to take a trade during Options X, because it's the institutions that control the market during Options Expiration Week. It's really the proprietary trading desks that make their money during Options Expiration Week by taking out the small and the retail investor that has bought and sold puts and calls during that week that are going to expire. They're going to take them out and make sure that those folks don't make any money and that they make all the money. That's just the way Options X works. All right, let's move on. Let's talk about the gold market. We'll go to GLD. And interestingly enough, GLD had a nice up day on Friday. And what you could see happening here is, it could be, and I don't know, we'll see what next week brings, but it could be back to the fear trade, right? And the fear trade is the market goes down and people rush to gold for safety. It's not a safety play, but like I've been telling you over the last several weeks, if not months, now we're in the seasonally bullish period for gold. And I told you that I expect gold, the spot gold price, to reach at minimum of $1240 to $1245 within the month of January. We're at $1223, okay, as of Friday's close. And I don't know exactly when we'll reach that number, but here's the kicker. It's $1240 to $1245 in January or higher. Okay, so that's not to say we can't propel higher. That's what translates to this pivot high like I've been telling you here. And we may stall out for a couple of days and go sideways just like we're doing here, and then we may propel up. So if we did that, we would propel up to the 200 period moving average or this this pivot high here, okay? So don't discount higher prices in January. It's starting to materialize, and I've been telling you this is a seasonally bullish period for gold. So those that were accumulating gold down here on my say-so, you're being rewarded now, and I think that there's higher prices in January for gold. So GLD should reach at least 118.5 to 119 in January and or higher. Okay, so keep that in mind. We'll leave it be and we'll take it one day at a time. And of course, I'll continue to update you on the price of gold as we move into next week. Oil. Okay, oil, and this is not oil, USO. I'm going to go to USO, and USO is still relatively weak, and now what you're doing is you're putting in a sideways pattern down at the lows. Now that could mean one of two things. Either this pattern will fail because it's already at the lows. See, the sideways pattern goes lower, and that was at the lows. Sideways pattern goes lower, sideways pattern goes lower. Now, one of these times, the sideways pattern is actually going to fail, and it's going to put in a reversal day. But as I keep telling you, we haven't seen the reversal day yet. And until we see a solid reversal day in the price of crude oil, there's nothing to do. Crude oil on the February contract right now is $48.21. Okay? Now, I think we're going to now go down to 45 and maybe even test 42, 43 before we see a definitive low. That's where I see crude going. And remember, over the last several weeks, I've been telling you, I believe everybody was saying 50. I said 48. I believed the whole time we were going to go to 48. Now we've been going to 48 and stalling and trading around 48. I don't think it's going to hold. I think we go lower. And if we go lower and the market pulls back over the next week or two, I think we'll finally see a definitive low, maybe towards the end of January. I don't know that for a fact, but we're going to have to take it one day at a time. And I will certainly let you know when we see that definitive daily low, where it's a capitulation low, it's a low reversal day with high volume finishing closer to the highs. And it's basically the throw-up day that we're looking for. We haven't seen it yet, and until we see it, we're not going to play anything oil-related or in the energy sector right now. Okay? Let's go to bonds and interest rates real quick. I'm going to go to the TLT, which is the 20 to 30-year Treasury bond ETF, right? This tracks the 20 and 30-year Treasury bond. Now, what you had here is you had, and I told you the cycle day on Wednesday, right? The turn day I expected Wednesday also included bonds and interest rates. Well, guess what? Bonds hit a high on the 6th, and then it failed on the 7th. On the 8th, it went down, and on the 9th, we had a little bit of an up day, okay? So it did play out, the cycle day turned, and what I said all along is that this 20-period moving average, which is the red line, okay, that's home base, okay? And if you look, go back in time, okay, the market likes to hover around home base. The market never likes to get too far away from home base. Got too far, back to home, right? Home base, way too far from home base, pull back to home base. Close to home base, okay? Got a little bit far from home base, back home. A little bit far from home base, back home. A little bit far from home base, starting to come back home. We'll see what happens. But the market never likes to get too far from home base. Home base would be the 20-period moving average. And that is one of the factors that I believed would play into the cycle turn date. And that's why I let you know about it. Basically, folks, I think that's it. We're going to come to you with another video on Monday after the market. This is basically all I have. I just wanted to give you a quick update and let you know where my thoughts were. Hopefully it's been helpful. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.